Hello, my friends, and welcome to the Short Vol Show Live. We are coming to you on a Monday morning right before the election, an exciting time period. Let me get centered here and put my guitar down for a second. And it's great to see you all. And coming into the election today, we have Vol in this morning with a little bit of a market rally. As I look on my list over here, it seems that for some reason, E-minis fell off the list for a second, but currently E-minis up 35 as we come into the day. Now, weekend Wall Street had us down all weekend, so it just goes to show what weekend Wall Street knows. And I titled this video being objective about your trading because I was thinking about this stuff based on a comment someone left on the last video. And what the comment said was basically it was criticizing, it was saying, look, this is what's going to happen on election. It doesn't really matter which viewpoint they had. In this case, it happened to be, they were saying, when the election comes, it's obviously going to be held up for days, and there's going to be a ton of volatility, and it's not going to get decided for a long time. Originally, the president's going to win on election night, and then the votes are going to come in from the mail-ins, and his victory is going to be cast into doubt. Now, I think this person maybe thought that they were providing some great insight. However, this sort of narrative has been put forth for months now. But regardless of what the narrative is that they were talking about, the problem I have with a comment is that somebody is completely convinced that they know what's going to happen in the future, and they're trying to convince everyone else around them that this is definitely going to happen in the future. And the point that I try to make with people is like, look, we don't know what's going to happen. So the more you convinced you are that something is definitely going to happen, the more you should probably examine what are the alternatives, what could happen instead that you weren't thinking about. As a market maker working with a risk manager, one of the advantages professional traders have over retail traders is most professional traders have a risk manager, somebody who, in my case, it was that guy's money that I was trading, so he's watching his money. You have layers of people above you that are keeping an eye on what you're doing. And I know that kind of goes against the narrative of the kind of the trader who's, swinging it big on the pit. But even the biggest traders that are swinging it big in the pit have to answer to somebody. Now, you might say, well, somebody's on their own. It's all their own money. And that can be the case. But most professionals have to answer to somebody and who's going to challenge their decisions and say to them, why are you doing this? And that is a huge tool that a lot of retail doesn't have. And so I challenge you to examine your ideas and say, well, maybe, what happens if I'm wrong? Now, another thing that as a professional trader, we like to look at is what's the worst thing that could happen? And you might say, well, that's a pessimistic outlook on life. However, this is what keeps us awake at night. What's the worst thing that can happen here? It's unlikely that we get a huge spike where we see a TVIX type or UVXY. TVIX went to $1,000, okay, about 6 months ago. From I think it started at $38, I believe. It went to $1,000. That's a thing of nightmares. And this is the kind of thing that we need to focus on. You need to focus on your risk. What is the risk? What's the worst thing that can happen to me? Because more times than you would imagine, the worst thing does happen in the investment world, especially when you're not thinking about it. The other aspect of this whole comment of being sure of what's going to happen and being sure of your beliefs and coming online and arguing with people and putting forward your opinions is it's kind of the thing that you're not going to change anyone else's mind on anything, really. The most you can hope for, and an important thing to hope for, is to change your own mind. Now, this is the reason, for example, that I consume media from a spectrum of sources. I watch Fox News and MSNBC. I watch I have conservative publications. I have liberal publications. I have independent publications that I consume. And the reason for that is because I want to form my opinions with that word, informed. I want to develop my ideas coming from as many sources as possible, because, there's a chance out there that I'm wrong. And while I'm not going to convince anybody else to vote for X, Y, or Z or whatnot, I may be able to convince myself to change my mind on something. And it may be not as big as like switching political parties, but it may be an issue or an idea. I think it's much more interesting to focus on individual ideas than to just join a team and you're on that team. The other thing I've been working on a lot is watching these programs on gurus, financial gurus, people that you go to help you make money, and a lot of them are fake. They're promising you riches, and part of the reason I do that is I want to know where kind of I fit into that equation, because I'm a YouTuber. I'm out here blabbing in front of people, and I think what I've learned from watching all this guru stuff is a lot of these people who make money or who are gurus, they're not making money by trading or whatever the product that they're teaching you about. Like, let's say you're a guru and you're teaching people how to do Amazon drop shipping. These people don't make money from doing whatever they're teaching. They make money as a teacher. So it's kind of like, you can't make money trading. Okay, we'll teach people how to trade. It's kind of that thing, right? So when you're trying to discern who's real and who's fake, one of the things you can look at, which should be obvious, but is this person actually interested in making money at the thing that they're teaching you about, or are they just all into selling you classes or something like that? In my case, it would be, when you're looking at different traders, are they focused on making money in their account and killing it, or what's their priority? Is it teaching you stuff? Is it coming online and doing YouTube videos, or is it actually making money in their own industry? And I would put forward to you, when you're looking for help with trading, if you follow the guys who, they're out there maybe helping out, they might post online and stuff, but their main focus is making that cash, being a success as a trader. And I certainly feel that way myself. It's more important to me in the long run to be a successful trader than it is to be a successful YouTuber. And I think that speaks to my authenticity as somebody to learn from. And, I generally do want you guys to succeed. I generally do want to be a successful YouTuber. I've been approached several times to make classes about the VIX or to sell a product where people say, we'll put money behind you, we'll do the advertising for you, and we'll help you develop a product so that we can all make money off of this. And I've always resisted that, because to me, success to me is being a successful trader. And I haven't always been a successful trader. In fact, since I've come back over the last 5 years, it's been a struggle. I had a decent year last year, and then I had a couple break-even years before that. I was very successful as a young man in my 20s. But since I've come back to trading, it's been a bit of a grind. It's been hard to adjust from being a market maker to being basically a retail trader. And the urge is there to sell out and say, okay, well, let's develop a program. Let's become like a Warrior Trading or one of these people and sell classes or have a boot camp or something like that. But to me, success is to win at this game and be a successful trader, put successful trades on. And fortunately for you, you get to follow the process because I'm transparent with my P&L. You can see it on the screen and you can see how it goes. Now, I would love for this account that I have in front of you to blow up and go from right now where it is to, 10 times that much. But the reality is that things don't generally always work that way, that you make 10 times your money. Even smart traders, you don't just come in and make 10 times your money. You could get lucky, and I could take shots. I could take, let's say there's $10,000 in my account. I could go ahead and take that $10,000 and buy 2 Tesla calls and just hope and pray that Tesla goes up. And maybe Tesla does go up, and I make a big amount of money. But that's not something that's repeatable. It's not a good risk reward, and it's just basically flipping a coin. So the beauty of the channel is that as I make the transition from market maker to retail trader, we can learn together. And I can teach some of the knowledge that I've been taught from other people and in life about trading, the VIX, options trading, etc. So there's my rant for today. All right, so let's take a look at the markets. We've talked before about how the VIX term structure right now is not in a good spot. Let's say that we're short the VIX, and best case scenario, the election comes out, there's a determined result, whoever your favorite guy wins by a landslide, and the election's over, we move on, their certainty is back in the marketplace, and the VIX comes in. All right, let me pull up the term structure here. Now, the fact that the VIX is like 5 points above any of the futures means that to get us back into like a nice contango, a nice shape for the chart, we need days where the VIX goes down and the futures don't move. It's going to take several down days in the VIX to get things back to a reasonable spot. Because look, if today the VIX came in 5 points and the futures didn't move, the chart would still be ugly. This line up here would be down a little bit lower, but we would still be inverted and it would still be ugly. It's going to take several days of down moves to get this chart back into line. And so if you were to short volatility, short UVXY or VXX, or if you have a short position on now and everything goes great and vol comes in, let's say 10 points from 37 to 27, these products are going to underperform to the downside. Now, they quote unquote underperform to the upside when we're in the opposite situation, but here, if the VIX comes in heavy, what's going to happen is the futures aren't going to move as much as the VIX, because we've got to get to the point where the VIX spot is below the futures again. The only way that can happen is for the VIX to move down more than the futures several sessions in a row. So we are way extended to the upside. I want to challenge what we say all the time, which is that the VIX term structure is not predictive. Because it really does appear to be predicting that we're going to be lower soon, because even the farthest back months are way lower than spot is right now. So we'll see what happens. But if it plays out and vol comes way in the next couple months, then we could kind of say, well, when the term structure is inverted like this, that's predictive that it's going to move lower. And we generally say that. Some people like to think of the term structure as, okay, well, when we're in contango, that means you should be short volatility, you should be short these products, and the lights, it's safe to be short, and everything's going to go down. When we're in backwardation, you shouldn't be short these products and stuff is going higher. But the reality is most of the time we're in backwardation, that's a signal that we're in some sort of brief spike, and things are going to move lower from that. And I'm not a perma bear. I'm a long-term permanent bear on UVXY and VXX for the reasons that they slowly move lower. However, in the very short term, I'm not a bear at all. I'm neutral on these products, and in the midterm, it changes. Sometimes I'm bearish, sometimes I'm bullish. But we are, in a spike at the moment, and it's a hard. It's going to be hard to make money to the downside unless we get a big down move, because anything short of a big down move is the term structure always wants to go back to contango, and it wants to get back to contango now, but it's a process of days of either nothing happening vol-wise or vol coming in. If nothing were to happen, let's say the VIX was to stay at 37 for the next 3 months, this chart would slowly adjust. The back months would slowly, almost imperceptibly move up until the back months were at a 37 or closer to 37. And this term structure would eventually adjust back into contango if we stayed at 37 for long enough. However, history has taught us that periods like this where we're at a higher level, let's say above 25 or even above 30, stuff comes in relatively soon. So all these all these thoughts are making me want to be short volatility coming into the election. We still have till tomorrow night to decide what, place your bets by tomorrow night. It's kind of like it's the Kentucky Derby coming up, right? And the last time to place your bets before the Kentucky Derby, or the biggest race of the year, is Tuesday afternoon. Now, I've also said to people, maybe sit this one out, and I haven't decided exactly what I'm going to do. There are tons of voices saying that volatility is going to spike after the election. There are tons of voices that are saying it's going to go lower, so much so that I tend to think it's going to be a little bit of a non-event, and there'll be time to adjust after the election, but we will have to wait and see. I've been blabbing for a little while now. Let's take a quick look at the chat before I let you go. Hey, what's going on? Those who can't do teach. Exactly. Morning. Hello, Felix Morissette. Hey, what's up, Warren the Idiot Masses? Spencer Dasboff, Michael Evans. It's funny, my buddy, the last time we were on, my buddy, Strangle. I like Strangle. That's good. I actually had an interesting situation where I actually did buy some shares of UVXY last week. I was short, I sold some out of the money calls, and I actually did buy 100 shares against them to kind of hedge my delta. One of the best positions when we're in a rallying stock market, and we're in a rally, the market's slowly moving higher, one of the best positions you can have is to be short out of the money calls and long stock against them, because the stock is the quote-unquote hardest kind of deltas you can have. We know that 100 shares of stock really does represent 100 shares of stock, whereas, you can sell an out-of-the-money call if Lululemon is trading $300. You can sell the $350 call, and you don't really want to, if you think Lululemon is definitely going higher, you want to buy stock delta neutral against selling those calls. But in the case that you buy an out-of-the-money call, you don't necessarily want to sell a bunch of stock against it, because what can happen is over time, the stock slowly moves higher, and the call you bought goes down in value or doesn't move, and any stock you sold against that call to hedge it goes against you. So when we're looking at out-of-the-money calls, we call them soft delta products. But one of the best positions you can have on in a slowly moving market is to be long a stock and sell some way out of the money calls against it, because the calls either don't move or go out worthless, and the stock that you own against them gains in value. Spencer, I like the idea of selling Strangles. I'm very careful when I sell Strangles in a UVXY or a VXX to not give up the put for too cheap. The reason for this is, earlier in my trading of UVXY, I sold puts a bunch of times in Strangles, and what would happen was the put I sold would blow up in my face. So I'd sell some puts for like 75 cents that were way out of the money, and all of a sudden the puts would be $2 in my face. So if I'm looking at selling like a Strangle in a UVXY, what I might do is move out a couple weeks. So if just to place an example here, let's look at UVXY here. If we look at these options that expire in 11 days, now this stuff is jacked to the moon, of course. 235 is a very high level. We know that's due to the election, so this might not be the best example in the world. But let's try to do it anyway. All right, so UVXY is 20 now, right? If we were to sell a Strangle, right, we might say, all right, well, let's sell a Strangle. If we were to pick equidistant strikes, so if this is 20, equidistant strikes might be sell the 30 call and the 25 put, right? So the 30 call is 137 bid at 2.6. It's very wide because the market's not open yet, but let's just take the midpoint of this. Let's just call it, I don't know, 190. This call is trading around 190, the 30 call. Let's look at the put that's $5 out of the money, the 15 put. It's only trading 50 cents, right? And that's due to the skew, right? There's a skew that makes the out-of-the-money calls cost a lot more compare with the out of the money puts. That's the reason for this is that everybody in the world wants to buy these out of the money calls to hedge their equity positions. B, if there's going to be a big move, a big violent move in UVXY, it's going to be the upside, not the downside. The downside you could roll down several days in a row, but like that knee-jerk move is going to be to the upside in UVXY. And in fact, we can pull up on our Thinkorswim. If I go to the center column here, and I can change what shows up on this option screen, and if I go to implied volatilities, we can see the farthest on the left here, if we go next to the 30 call, it's giving it a 331 vol right now on the skew. And you can see as we move up the strikes, the volatility goes higher and higher. That's a skew, volatility skew. And if we go down to the puts that are $5 out of the money, it's only 180 vol. And so you just want to be aware of that. It can still work out selling Strangles, but I would generally, whatever put you're considering selling, I would look down another couple strikes. And another way to kind of protect yourself against this is to move out a couple weeks maybe. So for example, if I were to move out to December, now this is a $20 issue, so it's hard to really do this too well, but if I were to move out to December, you could sell something like the 12 put, right, which is way out of the money and very unlikely to come in. 12 put and the 30 call. So you're moving your strike out farther on the put than you are on the call, just to kind of adjust for the skew and the fact that the puts are a lot cheaper than the calls. And in many cases with UVXY, the puts are so much cheaper than the calls that it's almost questionable whether to do the trade. I think it still is worth doing the trade, and but you just want to keep an eye on them and be cognizant that these calls are a lot higher priced than the puts are. It's almost like it's a different product. All right, dead air. So where am I? I'm right here. So yeah, we'll see what happens going into the election here. Pretty exciting time out there. And once again, it's perfectly fine to have a small position. You know, I have a small position right now. UVXY, my delta, I'm short 25 deltas. I really like this position. I'm short a little bit of gamma, but I'm not short that many deltas. So look at this. I don't have that much risk where it moves, but I'm collecting a lot of money every day. You know, I'm only short 25 delta. So as if it was right at this spot, it was as if I was short 25 shares, but I'm collecting $120 a day. So I kind of like that ratio of, you know, directional risk to dollars collecting. Now, you see short 13 gamma. That means that the delta is going to move by 13 every dollar. So down $2, I'm no longer short deltas. I'm flat now because 13 times 2 is 26. So down $2, my delta changes by 26, which makes me flat down $2. And in fact, when we look at this, the Greeks here, it has a column for down 10%, which is almost exactly down $2, and we can see my delta's flat. It happens the other way to the upside, up 50%. I always look up 50% or more when I'm looking at my risk because, once again, that's the danger here is that we get a spike. And up 50%, all of a sudden I'm short 150 instead of 25. So, there's no reason to bet the farm on this election. It would be a desperation move, and we don't want to be desperate. We want to be under control of our emotions and under control of what we're doing. So let's see SVXY. Well, SVXY is the same, you know, it's the same thing as UVXY. It's just that instead of being 2 times leverage, it's half times leverage. But in essence, it's the same thing, but upside down, right? We tend to think that SVXY is slowly going to move higher over time. It's not going to have as big moves, but it's the same product in a sense. And if we look at the skew, let's look quickly at the skew. And the skew is going to be reversed, right? Because this is an inverse product. So if we look, the calls moving up, out of the money calls, we see 36 goes from 49.50 down to 36.35. Now, as we get way out of the money, you know, if you see something, an outlier like here, like we see 36, 38, 43, and all of a sudden it says 73, well, look over to your market. The market's zero bid at 150. So looking at these implied volatility can be less meaningful when the markets are closed and there's these really wide markets. But yeah, SPXY is the exact opposite of UVXY. We expect it to slowly move up over time. The skew is to the downside. The downside puts are more expensive in relative terms than the out-of-the-money calls. And well, the other thing about SPXY is just there's a little less volume. So you want to be cognizant of the fact that it's harder to get stuff done when there's less volume. There's also less volume. Let me just state once again, there's less volume in UVXY than VXX. Generally, VXX is preferable to trade because it has more liquidity. You can get in and out of stuff better. And I currently have positions in both. I'm short some deltas in VXX. Sorry, that was wrong. So I'm short 153 deltas in VXX, and I'm very close to flat in UVXY. Just buying SVXY, yeah, just buying SVXY is a viable thing for people to do. Of course, if the market crashes, it's going to go down. But just buying it and holding on to it, it's a replacement for buying the S&P 500. So you can look at the returns, compare the S&P 500, but in a market that is always going straight up, buying some sort of leverage S&P product is going to do better than the SVXY. But in a market that just goes sideways forever, SVXY will outperform the market because remember, if we're just going sideways forever, these products are going to keep moving. SVXY will keep moving up, whereas the market won't move anywhere. So in a sense, you can make money in SVXY when the market's either going up or not doing anything, whereas with just buying the market, you can only obviously make money if it's going up. That's sort of the difference. The thing that takes people away from SVXY is that it's only 0.5 leverage, and thus it ties up your money, which might possibly be better used elsewhere. We're always trying to do the best we can with the limited resources we have, and a lot of people just think that SVXY is just not leveraged enough and not sort of an exciting enough product to have their money stuck in. Now, it's not about excitement here. It's about making money, right? Don't get that too confused. But yeah, if we look at SVXY over time, we can see since that March down move, it hasn't, it's slowly building, certainly, but it hasn't performed as well as we might have hoped. I remember I was looking at putting butterflies on out in June here and thinking like, oh, definitely by Christmas this could get back to 50, but it doesn't appear like it's on that path right now. We'll have to see, of course, what happens after the election. Anyways, I've already been pretty long-winded. I'm going to let you go, but I will tell you next video I am going to do another installment of my journey, which has been popular with some people. So we'll get to talk about that next time. Thanks to everybody for your support. I really appreciate all the members and Patreon supporters. That is really great of you to do that because that's pretty much the only way that I defray the costs for making these videos. And it's great that you support the channel. We'll see what happens today. I'm actually kind of surprised that the market's up today, but I don't think anybody... Actually, people were kind of predicting it in... I told you guys I'm in sort of a private moderators chat for Facebook, and a lot of people were saying, well, it was the end of the month, last session. This is the first session of the month, so people are putting money into the market based on that, possibly today. We did see a big volume spike on the close on Friday, but good luck, best of luck to you, and I will give you information. I will be appearing on the Option Insider Radio coverage of the election tomorrow night. I will provide information for that on Twitter, but as of now, it appears I will be on at 7 p.m. Central Standard Time, starting at that time. And I'm not going to reveal who's going to be with me, but it's going to be a lot of fun. Thanks for tuning in today, and best of luck to you trading today. See you soon.